Hello and welcome to Personal Finance Unchained, your go-to channel for mastering the art of managing your money. First and foremost, I want to thank you for taking the time to watch this video. I know your time is valuable, and I appreciate you investing it here with me. Thank you for tuning in to Personal Finance Unchained, and let's dive deeper into the world of investing for beginners with part 2 of our series. If you haven't watched part 1 yet, make sure to check it out for a solid foundation in key investing concepts. Now, let's get started and continue building your path to financial prosperity. Now that we've set the stage, let's continue our steps to enhance your investing journey. Step 4. Diversify your investment portfolio. Diversifying your investment portfolio is essential for managing risk and potentially increasing returns. By allocating your investments across different asset classes and sectors, you can spread risk and reduce the impact of market fluctuations on your portfolio. For example, consider investing in a mix of asset classes, such as equity, stocks, debt, bonds, real estate, and gold. Each asset class has its own risk and return profile. Equities generally offer higher potential returns but are more volatile, while bonds provide relatively stable income with lower risk. Real estate and gold can act as hedges against inflation and provide diversification benefits. To illustrate, let's say you invest 1 lakh rupees in a portfolio consisting of 60% equities, 30% bonds, and 10% gold. This diversified portfolio can help protect you from market volatility, as different asset classes often perform well under different market conditions. For instance, if the stock market experiences a downturn, the bond and gold portions of your portfolio may provide some stability and offset potential losses in the equity segment. In addition to asset class diversification, diversifying within each asset class is crucial. For equities, consider investing in different sectors, such as technology, healthcare, finance, and consumer goods, as well as companies of varying sizes, large cap, mid cap, and small cap. This approach ensures that your investments are not overly concentrated in a single sector or company, reducing the impact of any individual stock's poor performance on your overall portfolio. For bonds, diversify across various issuers, such as government bonds, corporate bonds, and bonds issued by financial institutions. This reduces the risk of default or credit risk associated with a single issuer. Mutual funds and exchange-traded funds, ETFs, are excellent tools for achieving diversification, as they typically invest in a diverse range of securities across various asset classes, sectors, and geographies. By investing in these funds, you can gain exposure to a broad array of investments with a single purchase, making it easier to create a diversified portfolio. In summary, diversification helps to manage risk and potentially increase returns by spreading your investments across various asset classes, sectors, and securities. Make sure to review your portfolio periodically and rebalance as needed to maintain your desired level of diversification and align with your financial goals. Step 5. Develop a long-term investment strategy. It's essential to develop a long-term investment strategy that aligns with your risk tolerance, financial goals, and time horizon. By focusing on the long term, you can take advantage of powerful wealth-building concepts like rupee cost averaging and compounding. Rupee cost averaging is a disciplined investment approach in which you invest a fixed amount of money at regular intervals, regardless of market conditions. This technique helps you avoid trying to time the market and reduces the impact of market volatility on your investments. By investing consistently, you purchase more units when prices are low and fewer units when prices are high, resulting in a lower average cost per unit over time. For example, suppose you invest 10,000 rupees per month in an equity mutual fund. In the first month, the unit price is 100 rupees, and you purchase 100 units. In the second month, the unit price drops to 90 rupees, and you buy 111.11 units. In the third month, the unit price increases to 110 rupees, and you buy 90.91 units. Over these 3 months, you've invested 30,000 rupees and purchased 302.02 units at an average cost of 99 rupees and 34 paise per unit. By using rupee cost averaging, you've reduced your exposure to market fluctuations and potentially improved your long-term returns. Compounding is another essential concept in long-term investing. It refers to the process of earning returns on both your initial investment and the accumulated returns from previous periods. Over time, compounding can significantly grow your wealth, especially when you remain invested for an extended period. Let's consider an example. If you invest 1 lakh rupees in a mutual fund that earns an average annual return of 10%, after 1 year, your investment would grow to 1.1 lakh rupees. In the second year, you would earn returns not only on your initial 1 lakh rupees investment but also on the 10,000 rupees in returns from the first year. At this rate, your investment would double in approximately 7.2 years, and after 20 years, it would grow to over 6.72 lakh rupees. To benefit from rupee cost averaging and compounding, maintain a disciplined and consistent investment approach, and focus on your long-term goals. Avoid making impulsive decisions based on short-term market fluctuations, and periodically review your investment strategy to ensure it remains aligned with your financial objectives. In summary, by focusing on a long-term investment strategy and employing techniques like rupee cost averaging and compounding, you can better manage market volatility, reduce investment risks, and potentially grow your wealth over time. Step 6. Regularly monitor and adjust your investments. Monitoring your investment portfolio and reviewing it periodically is crucial to ensure it remains aligned with your financial goals. Regular reviews allow you to assess your investment's performance, identify potential issues, and make adjustments as needed to maintain the right balance between risk and returns. For example, let's say you started with a balanced investment portfolio, allocating 60% of your investments to equities and 40% to bonds. Over time, due to strong stock market performance, the equity portion of your portfolio has grown to 70%, increasing your exposure to market volatility and potential losses. By reviewing your portfolio periodically, you can identify this imbalance and rebalance your investments to restore your original asset allocation. To rebalance your portfolio, you might sell some of your equity holdings and use the proceeds to purchase bonds or other fixed income investments. Alternatively, you could redirect your future investments towards bonds until your portfolio's asset allocation is back in line with your target. Another example could be that you initially invested in several stocks from the technology sector, which performed exceptionally well over the past few years. However, upon reviewing your portfolio, you realize that your investments are heavily concentrated in one sector, exposing you to higher risk. To diversify your portfolio, you might consider selling a portion of your technology stocks and investing in other sectors, such as healthcare, finance, or consumer goods. Periodic portfolio reviews also allow you to assess the performance of individual investments. If a particular stock or mutual fund is consistently underperforming its benchmark or peer group, you may consider replacing it with a better performing alternative. As a general rule, consider reviewing your portfolio at least once a year or when there are significant changes in your financial situation, such as a job change, marriage, or the birth of a child. By keeping a close eye on your investments and making adjustments when necessary, you can maintain a well-balanced and diversified portfolio that continues to support your financial goals. Remember, taking control of your finances is a journey, and it starts with these fundamental steps. By following this step-by-step guide to investing for beginners, and continuing to educate yourself, you'll be well on your way to financial success. I hope you found this step-by-step guide on investing for beginners helpful and informative. Remember, managing your money is an ongoing journey, and I'm excited to be a part of it with you. So, sit back, relax, and let's empower ourselves to take control of our finances. And if you find this video helpful, don't forget to hit the subscribe button and share it with your friends and family. I can't wait to see you in the next video, where we'll continue to explore personal finance and help you take control of your financial future. Thanks for watching. Until next time, stay financially fit and stay tuned to Personal Finance Unchained.